Before we start our today's lecture, check out our 7-Figure Traders program, a program dedicated for you to become a high-performance trader, only going for $115 per month with trading signals included. Find the link in the description box below and join the winners. Welcome back to Bonex Investment Group. In this video, we are going to talk about candlestick strategies, basically trading off candlesticks only without any other things. So it is said to be profitable, you must have something simple. Actually saying most profitable traders have a very simple trading strategy. So if you have one and can sit on your hands 50% of the time, you will make a lot of money. In this video, I'll give you a very simple trading strategy which you can backtest and follow and have a positive return. But before we talk about anything else, trading is not easy. You need to keep reminding yourself that you are competing against very smart people, and for you to make money, you need to behave like one. So without further ado, let's jump into the content. Firstly, when we talk of candlesticks, we need to know where to look for the candlestick reversal patterns. We are not going to delve in naming these candlestick reversal patterns, where we are talking of bullish engulfing, bearish engulfing, hammer, shooting star, and so forth, because all that is free content that you can get online for free. So firstly, candlesticks are the prints that shows us whether the market is rising or dropping. We need to know where to look for reversal patterns so that we can act at those particular points. The first thing we need is to know where to look for the candlestick reversal patterns. The bearish, the bullish, the railroad track, and all other candlestick reversal patterns that you can know of, you need to first know where to look for those. So for the purposes of this video, we'll only talk of only 2 points which you are going to look for the candlestick patterns. First one is yesterday's high or low. It's something that may seem common knowledge, but we say yesterday's high or yesterday's low usually holds some liquidity. What is liquidity? These are free funds within the markets. However, not every high or low is valid. The underlying principle is we respect yesterday's high or low if it is a day of consolidation. What is a day of consolidation? It is defined as a day whereby its opening price and closing price are almost on the same price. If we open a day whereby the opening price is almost at the closing price, it's almost in a same line or a similar price, we actually call that particular day a day of consolidation. If ever we get a day of consolidation, whilst we know the trend or we have the bias by breaking of structure and so forth, we can know that free money is on its way, because we mark the high and the low of that particular day and expect to see the following day to come and retest that low of the previous day of consolidation. This is the point where you expect to find a candlestick reversal pattern that you have seen in several texts of trading online. Let's have an example of what I am talking about. This is pound against the US dollar, which was in May 2024, and we had a day of rise. This was actually a day that gave us the bias of the market, meaning that we are now looking for buys. In that particular day, we had this first day where the opening price and the closing price were almost at equal prices. The high and then the low was actually set. What did we see at the low of this day of consolidation? The market came to shoot to that particular price point, gave us this hammer and a candlestick reversal pattern, which is confirmed with this green candle, and the market went in this particular direction. This was around 45 pips. A 45 pip move could satisfy a 2-to-1 reward risk ratio on this particular move. However, this day also ended as a day of consolidation. Opening price was actually equal to closing price. On this particular day, what did we see? we saw a 3-candle arrangement where we have a red, green, and green candle, meaning that at this particular price point, that is where we were going to make our entry, because a candlestick reversal pattern was actually issued at this particular point. What did we see? We can see that this day as well was a day of consolidation, opening and closing at almost equal prices, meaning that we were also expecting to see retest of the low of this particular day, and the market actually gave us a hammer, and after that hammer it actually went in our direction, which also satisfied a 2-to-1 reward risk ratio. So basically we are saying yesterday's high or low is also a valid point where we look for the candlesticks that we are talking about in all the market text all over the online. Then the second position where you need to look for the candlestick reversal patterns is the weekly high or weekly low. Each and every week sets a high and a low. The weekly profile is seen on the H4 time frame. If you switch your platform to H4, you would see the opening and closing of a week, and within that week we say the underlying principle is what goes up must come down, and what comes down must go up. This is basically the weekly profile where we have a pump and dump, or a dump and pump, whereby the market makers will pump the wick to its high and dump it to its lows. So below is the structure and point, and the point we must expect to see a candlestick reversal pattern. In this particular case, you can see the structure that we expect, where we have the weekly front side and the weekly back side. The weekly front side will experience the pump, and at the top, that is where we expect to see a candlestick reversal pattern, which is the candlestick reversal position. Same applies when it is in inverse. The weekly front side, we drop, and then we reach a point where we will be looking for candlestick reversal of the H4 time frame. So basically we are saying switch the time frame to H4, look for pump, and then within that pump move or pump flow, we are actually monitoring for a candlestick reversal. At that point, when we see a candlestick reversal, that is where we make an entry. So let's now go over the charts to see this in practical example. So this is euro against dollar. We are just going to reverse backwards to see the pumps and dumps, right? We need to see a pump and dump. Someone can actually find this difficult. In this particular case, you can see the market actually was in a choppy drop. What we call a pump is a fast move in one unilateral direction. The market gave us 3 candles in this particular direction, meaning that there was involvement of market makers. After that, we can see a candlestick reversal pattern in form of a 3-candle, green, red, red in this particular case, and at the close of this one, that is where we were going to make an entry, right? So to remove the subjectivity, we may employ the trader's dynamic index, which is this one, whereby we say the point of reversal after a pump or dump is where we coincide by having a shark fin, whereby the green line pierces outside of the bands. In this particular case, we can see this week did not have a pump and dump. Even if you check the relative strength, it was almost straight, meaning there was no pump or dump. In this case, there was a drop of the market. When the market went to the downside, it actually also gave a shark fin at this particular point. A shark fin was issued and a candlestick reversal pattern was issued, where we had this particular close as our point of entry, and the market went to the upside as a pump. After a pump, we expect a dump, and there was a candlestick reversal pattern at this particular point coinciding with a shark fin like this, where we could make our trade to the downside till the end of the week. So we are just saying when they pump, when they dump, you need to be looking for a candlestick reversal pattern. To remove the subjectivity, you can confirm the point of reversal with the trader's dynamic index, like in this particular case. We had a point in this case, where we had a shark fin and the market went to the upside like that. So basically, these are the positions where you need to look for the candlestick reversal patterns. It's not about memorizing the bearish, the bullish engulfing patterns, the hammers, the shooting stars and so forth, but to know where to look for them. We've talked about the yesterday's low and yesterday's high, and we've talked about the weekly high and weekly low, which you can as well confirm using the Traders Dynamic Index. On that note, we've come to the end of our today's video. Thank you for watching. Like and subscribe, and I'll see you in the next one.